We got some new inflation data last week, and there's actually a little bit to celebrate there, but there's also a bit to still be wary of. So last week we got August's inflation data from the US federal government, and it showed that the aggregate pricing level from July into August increased 0.1%. And that's a pretty good bit of information. The Fed would like to see, our group of economic policy experts here in the US would like to see inflation at around a 2% rate. So if you take the July to August move of 0.1% and you trend that out over 12 months based on how the data was reported, you get to an annual inflation rate of 1.4%. So that's beneath the Fed's 2% target, and that's a very good thing given that in recent history we've seen inflation rates here in the US of 8%, even 9% year over year. So we're looking between 4 and 5 times what the Fed would deem to be a sustainable, healthy level of price increase. And by the way, it's not just the US that's facing these inflation challenges. This is happening all over the world, frankly. The UK and Canada and Australia and Israel and all over, we're fighting inflation battles. So the July to August move was nice, sort of in a month-on-month basis. But there's a couple reasons to be a little wary of that data, unfortunately. The first is that the data that came out in July that showed what pricing did from June into July, that inflation rate was actually flat. The aggregate price level did not move from June to July. So that was very good news, and the issue there is we need to chain a lot more months together where price levels aren't moving to get back to a healthy 2% or below inflation rate. But it was nice to see the aggregate pricing level not move from June to July. It's a little frustrating that in an environment where interest rates are going up, and the reason you push interest rates up is to try to suppress this price inflation. So interest rates have gone up, and yet we still had a little bit of price move upward from July into August. It was only the 0.1% month over month move, but it still moved upward even when we're pretty aggressively raising interest rates at the moment. So that part isn't great news. The other bit that's not great news is what happens when you look not just at the month over month move, but when you look at the most recent 3 months compared to the 3 months before that, or the most recent 6 months compared to the 6 months before that. You can do the same thing with a 9-month window and a 12-month window. And when we look at what inflation has been doing over those windows of time, the picture isn't nearly as nice as what we've seen in the most recent month-over-month moves. And these longer-term views are what we are looking at in this chart right here. What we see here is the inflation rate annualized across these different windows of time that I've talked about. So the blue line is showing what's happening with inflation month over month. This is the 1-month move where we've just annualized it. And you see the blue line is the choppiest. It's bouncing all over the place. And we expect that given these month-over-month moves can be, even small shifts in the month-over-month move can lead to larger changes in this annualized inflation rate. So we see that at its peak, month-over-month inflation would annualize out to north of 15% inflation. But because these last 2 months have been so mild in terms of July being flat and August being up 0.1%, we see the blue line move in the ways that we'd like to see it. We see it collapsing down below the Fed's 2% target, and that's a good thing. That's what we're trying to get for the pricing picture on the whole. Unfortunately, as we see from these other lines, it really is only the 1-month price movement that's favorable, that's trending in the way that we really want it to. You see the orange line is the 3-month line. So that is the price level over the last 3 months compared to the price level in the prior 3 months annualized. That number has ticked down a bit, but it's ticked down just below 10%. So it's still much higher, 4 to 5 times higher than the Fed would recommend. And that's a number that we need to keep attacking. That's why you look at that rate, and that's why you want to keep raising interest rates to try to combat that inflation. Then we get to the gray line that's showing the 6-month window, the most recent 6 months against the prior 6 months. The yellow line is the 9-month window, and the purple line is the 12-month window. So we see that gray, yellow, purple, 6 months, 9 months, 12 months. We see all those lines are still moving up, and they're all getting close to the 10% range, or they're all in this 8 to 10% range. And those inflation rates are just much too high. So that's why we can see an inflation number in August that's only up 0.1% from July and say, okay, that's a good thing that price levels aren't moving up any higher than that. We're frustrated for two reasons. The first is prices are still climbing, even though interest rates are going up, even though gasoline prices are coming down. So it means there's still a price problem to be solved out there. The other reason is we look at these inflation rates here that are showing what's happening over longer windows of time. And these inflation rates are still much, much too high. So that tells us we should expect the Fed to continue raising interest rates. In fact, Fed Chair Jerome Powell said, that history is replete with lessons where central banks and other economic authorities have given up the fight against inflation too quickly. So our Federal Reserve is very much dedicated to trying to pound these price levels down to where they need to be so that Americans can afford everyday goods, food, shelter, energy, all the rest, what you need to live, a modern quality of life. We need to make sure the pricing of these goods and services don't race so far ahead of wages that people can't afford the things that they are used to buying for themselves to keep themselves comfortable and sustain themselves and their families. So we see these price levels in this chart over the longer periods of time that are still way, way too high. They may not even have crested yet. They still seem to be trending upward. And that's why we should expect these interest rates to keep going up. And when interest rates go up, it does absolutely have knock-on effects for the broader economy. It puts economic growth at risk. It puts the labor market at risk. And that's why you hear talk of, is there going to be a recession? Are we going to have more unemployment challenges going forward than we've had to this point? We've already heard of a lot of layoffs, particularly in the technology sector. Are those layoffs going to spread more widely? Those concerns grow as we continue to raise interest rates and don't see these longer-term price trajectories move the way we need them to move. So that's why there's some anxiety in the market, even though the month-on-month inflation moves are nice. They're within the 2% that we would expect. We're fighting a longer-term battle. That's what these charts are showing, and that's why we need to batten down the hatches and prepare for the possibility of a bit of an economic storm ahead. So thanks for watching. I appreciate it. If you enjoyed the video, click like, click subscribe. If you have any thoughts about what you want to see in terms of video topics going forward, I would love to hear them. Leave a comment below, and we'll talk soon. Bye-bye.